Now let's understand what's happening in the global market. Some pressure on stocks, of course, on Wall Street. The Dow Jones opening lower by 200 points on fears that the Fed will keep tightening into a recession now. Fed, of course, is going to be meeting. The FOMC meeting is going to take place sometime next week. Markets are expecting a 50 bips rate hike, and this especially after Jerome Powell's speech last week. Also, we are looking at those non-farm payrolls. The expected report has helped. It's added to the anxiety around the Fed's actions. S&P 500 also trading slightly lower. But among the bigger trigger that investors are closely watching are the easing of norms, of COVID norms in China. So how will that change the direction of FDI? Will Indian markets continue to see the kind of rally that we have seen if Hong Kong and China stocks actually go north? Is the question I'd like to pose to Craig Erlam, Senior Market Analyst at OANDA, who's joining us on India Tonight. Always good to have you with us, Craig. Craig, market sentiment has been dampened by the U.S. jobs data. This happened on Friday. It raised fears of persistent inflation and now fears of the Fed going in for that added tightening. Today's big cue, of course, was the reopening of the Chinese economy that enthused Asian bourses. European stocks remained cautious. Where do you think the truth really lies about reopening of the Chinese economy, and how do you think that's going to impact the markets from here?
I think the China story is huge because not only have we seen actual steps to make restrictions more targeted more recently, and we've seen a lot of talk that we're going to continue to see that type of approach, but we've also seen rhetoric along the lines of suggesting that the new COVID strains that we're seeing in these outbreaks are not as harmful as previous. So that really justifies the less strict approach. And then you see reports that suggest that from January, as early as January, we could see the wave being downgraded to a category B rather than category A, which again gives justification for a more of a hands-off approach to the any COVID outbreak, similar to, maybe not quite so similar to what we've seen everywhere else, but a more closely aligned to what we've seen everywhere else, which has enabled other economies to recover over the course of the last 12, 18 months. So I think this is huge. We've got to remember, again, China is the world's second largest economy. It's not just countries in Southeast Asia where we've got so closely knitted supply chains that rely on China for growth. If China's doing well, it enables other countries to do it better. If China's doing badly, it enables other countries to do it a little bit worse. So I think it's really important, especially when you're looking at Europe, for example, where we're already seeing enormous headwinds. They've got massively close trade ties with China. So a strong Chinese economy is good for Europe as well.
This kind of scenario then, Craig, do you see a risk on or a risk off kind of scene? What are the factors that will determine where FDI now flows?
So I think in terms of, I think they've all got their own stories. So I think for Europe, there's still going to be a little bit of caution because we've got, we're seeing a bit more colder weather now. And I think we're going to start to see gas stores start to head in a different direction than they have done now for a number of months. They've got close to 100%, but now we're going to start to see some of that used up. And I think the worse the weather gets, then I think sentiment could be dampened slightly by that, especially if we see another escalation on the sanctions front after the price cap that was announced on Friday. From China's perspective, I do think we could see much more of a bullish front, especially if we start to see policymakers act on the speculation that we have seen around loosening COVID restrictions and treating it a little bit less strictly. And from India's perspective, I don't see any change in terms of what China's done on foreign direct investment to India or the performance of India's economy and stock market over the medium term, because I don't think any business decisions that have been made to, for example, diversify supply chains, for example, is being made just purely based on the zero COVID rules. I think it's something that's been in the works, probably going back to the kind of trade war between the US and China. This idea that companies over many decades of globalization have become surprisingly become very vulnerable to disruption in one or two countries, and therefore the need to diversify has become a real priority for companies. And I think the pandemic really exacerbated that to an incredible degree, and now the war in Ukraine further again. So I think that's something that's a long-term decision that's being made, and that India could look to very much benefit from. And I don't think anything that's being announced currently in China is going to change any of that.
The other moving piece, and I was having a discussion about crude oil prices just a moment ago. If indeed China is reopening its economy, whether it happens now or a little later, do you see stronger up moves in the commodity markets, including crude oil? Because that's going to have a bearing on how these markets also react, and the Indian markets in particular, and how attractive it looks depends a lot on how we manage our oil bill.
Well, I think your previous guest made some really important points in relation to this in regards to the price of crude oil is being driven by so many different things, which is what makes prices so volatile and makes them so difficult to predict, even for the next 2 or 3 months, let alone the next 12 to 18 months. I think China is a massively important part of this. It is one of the world's largest consumers of crude oil, and therefore a stronger economy is going to be beneficial. But we shouldn't be naive about this. The reopening process for other countries did not go smoothly. If we see less restrictions in China, that means that we are going to see more COVID cases. If we see more COVID cases, that means we're going to see hospitals, for example, become much more used, and therefore there is the potential for them to not be able to keep up with capacity. So we may need to see restrictions just to reduce the burden on the health system, so it may not be quite smooth sailing as some hope just from a relaxation of COVID curbs. That's one factor that I think is going to be a driver of the oil price. The other is the price cap, as your previous guest alluded to. We don't know how that is ultimately going to filter through. I don't think it's going to make any difference to Chinese or Indian purchasers of crude oil. I think they are too big a purchaser, and therefore do have a lot of weight behind them on that front. And also, as well, the point of this cap isn't necessarily to reduce Russian crude output to any significant extent. It's not to upset the supply-demand side of the equation. It's to reduce the amount of money that it actually makes, if possible, from the sales of these crude, and therefore give extra bargaining power to a country like India and China. So what you could effectively see is Russia wanting to keep China and India sweet, and therefore accepting a slightly lower price that doesn't necessarily abide by the price cap, but it does effectively keep them sweet. So there's potential benefits there from India, whether it participates in a price cap or not. And that's something that the G7 is looking to capitalize on as well. It's where does the bargaining power lie? It's not necessarily just designed to try and reduce Russian output, even if that is probably going to be a small side effect of it.
Very quickly, because this is going to be the other moving piece as far as bond market action is concerned. Do you see the Fed and ECB both slow the pace of monetary tightening after those back-to-back 75 bips hikes and go with a hike of 50 bips this December? Because a lot of investors are going to be looking at the end of the central bank's rate hiking cycles, and that's really going to determine how exactly they want to play these different markets when it comes to equities.
So I think 50 basis points from the Fed is nailed on at this point. It's just a case of how many more will there be. The terminal rate is far more important at this point than the December move, because that's been communicated so effectively up until this point. I think there's very little, if any, risk of a 75 basis points at this point in time. The difficulty is that jobs report, everyone's focused on the NFP number, the unemployment number, things like that, the tightness in the labor market. The Fed's focused on the wages, and that was a massive setback. Not only was it higher than the 0.3% monthly number that was expected, it was double. And that really throws a spanner in the works. The last one was revised higher as well. The Fed is concerned about inflation becoming entrenched. We know it's going to fall next year because of base effects and energy prices and things like that. But the prospect of it becoming entrenched is what the Fed fears most. And that wage number from Friday is a massive setback. It won't change the outcome for December, but it could change the outcome for the terminal rate. And that's something that the ECB is going to be wary of as well, especially considering it was so late to the party. So we will see a slower pace of tightening, and I think that's the right thing to do. But I still think there's an enormous amount of uncertainty around where interest rates will ultimately end up and for how long.
Fair enough, Craig. Many thanks for joining us with your perspective. Always good to connect with you and get in your perspective on global markets and the kind of trajectory they are following. Thanks very much for joining us on India Tonight.
Thanks for having me.